All right, what started out as a really promising day today ended up not being so promising. So I'm going to kind of show you why today actually started out really well and has some really good potential to kind of avoid correction in the pullback, avoid correction, and actually make it back to all-time high, or well, at least above 4,600 by the end of the year. Really, really good potential. I mean, it was that good this morning. And then I'm going to show you why that we lost it all. We lost all that potential. And then again, why it is more likely and why it's always been my expectation that this will end up being more than just a pullback and will end up being more of a correction that that we've had plenty of, 2022 being the most recent, 2020 with COVID, 2018. I'm going to show you more, again, the signs from a technical perspective as to why we shouldn't expect it to be over. As much as it was so nice to see this morning, as much we need to be aware that anything can happen, and we need to be aware of when it would end. But more likely, we're going to end up with more weakness to come as early as next week even. So I'm going to break that down in today's video. Big moves and especially the dollar this week. It's had an impact on metals. It's had an impact on commodities. It's had an impact on yields. Big predictable moves that are putting a lot of pressure on risk appetite in general over the past couple of weeks, especially. We're going to take a look at that. And then our trade idea is a stock that's kind of a bellwether staple company that finally kind of gave a bearish signal today for the first time. And it's different than the other times it's given it that kind of failed. So I'm going to show you what that signal is, why it might not fail this go around, and how we're going to actually trade it. It's a little different than maybe what you'd expect. So let's go ahead and get started. Today is Friday, September the 29th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching this here on our blog, check out some of these other things over here on the right, including our Market Outlook live video I do at 3:30 Eastern time when I do these videos. Come down to the bottom, click this heart. It opens up this tab. I hit that like button there. Same thing here, click this thumbs up icon. It opens up this tab. I hit that like button. Again, the more you do that, it helps us get our content out to all of our followers on those platforms. That's why we always ask day after day. So we really appreciate those. Our goal is to get to 100. We took a slide back from the 80s, tacked down to the 60s. So if you have a second, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we started off really well today, and you'll see that here later. Very, very good prospects for what may be the beginning stages of an intermediate rally, right? The ending of this decline and the beginning of a new rally. It didn't finish the day that way, as you can see, or the week, and we'll see by the end here. But you did get the near-term line up. It did get in bullish territory. It was actually above 80 when we were at the highs of the day today. Obviously, we did not finish at 80 today. We came all the way down, and like it was the last time, if this is where the near-term line peaks, then that's going to be, it would be obviously a much lower high point compared to the last near-term peak, and it would be really bearish. So we'll see if that ends up being the case, but as of right now, that would be a very bearish near-term peak. Considering the momentum line didn't go up very far and is already back down in the bearish territory, then, that would suggest, nothing's 100%, but that would suggest that the near-term line is probably going to peak pretty soon too. If not today, Monday, and because Monday, obviously if we rally on Monday, that would be the 13th Monday in a row. So at this point, you just kind of have to assume that every single Monday will be an update until it's not, right? Until that pattern breaks. So assuming we go up on Monday, the near-term line goes up, however much we end up going up. And then, if it stays below 80, that would be a sign. That would be a very bearish peak. And like I said, the momentum line suggests that that's a likely pattern to happen. The intermediate line still in the reversal zone. Without the near-term line getting to 80, it's probably going to stay down there. If it does come up, it'll just be barely. And we'll see if we get the short-term sentiment back down into the reversal zone again. So something to keep an eye on for this next week as we start a new quarter. The Nasdaq actually finished higher today, but still has the same problem. Its momentum line got a little bit higher too. It didn't get in the reversal zone, so you wouldn't expect the near-term line would either. And if it does, it'd be very temporary, right? Like this one here, and it would end up being a pretty bearish peak. This would be a bearish. The intermediate line still in the reversal zone, and pretty bearish there. Looking at the Russell 2000, which has been the most bearish index, it's been like more bullish on this little short-term rally we've had. Its near-term momentum line peaked yesterday, and the near-term line is already coming down today. So that's how bearish this was. One of the more bearish indexes, a little bit of a this candlestick pattern there. Let's see, what was that one? Dark cloud cover, I believe, is the name of that one. Not as strong because there's not as much of a rally to reverse with it. So, but it is a candlestick pattern when you gap up and then close down, past the midpoint of the prior day's bullish body. Its intermediate line at least is out of the extreme lows, but it's still easily in the reversal zone. So you can see there, its market sentiment line is actually fallen now into bearish territory. So the Russell 2000, according to this chart, you could argue it is back into correction mode. That we're expecting the S&P 500 and the others to get into themselves. The Dow Jones, you can see it actually has the strongest momentum. Market sentiment line still up there in the upper half of the chart. It was also pretty down today after a pretty sizable gap to the upside, down 2.5%. Again, this would even be a more bearish peak because it didn't even get above 50, the near-term line. And the momentum line's already into the reversal zone there. So you would not anticipate that near-term line to get too much higher. Again, we're expecting that we're going to rally on Monday. It probably won't be that big of a rally, kind of like last Monday and the Monday before that. They weren't very big rallies either, but they were still positive and they kept the streak alive. So you expect that we'll get a lucky number 13 here on this coming Monday, which would be, again, first day of a new quarter. Of course, how big it is and how much we follow through on it, that would be the question. And considering what we've seen the last couple of weeks, you wouldn't expect it to be very big, and you wouldn't expect it would have been much better had we followed through on today's open. Then I would have expected we'd had a really good Monday, but obviously not the case. Let's look at the weekly market forecast chart for the S&P and the Russell in particular. So your intermediate line, your short-term sentiment line is not as bad as it was earlier in the week at the lows. We did not get the cluster. We came very, very close. Excuse me, not the cluster. The bull tag. We came very close to getting the bull tag by the end of the week. Late little rally here, off of the lows today kind of helped avoid that. But that's how close we were to a bull tag. Your short-term sentiment lines are both in the reversal zone, so they were extremes when we were at the lows. So that's a relatively good sign. The Nasdaq also avoided the bull tag. We didn't have one at all this week like the S&P did, but we got the light pink shading. We are finally below 80, so we are set up for a bull tag next week for the Nasdaq 100. The Dow Jones did get the bull tag, so it was so far below it, it was kind of hard to get back up above without being really bullish. Its intermediate line has crossed below, barely, 56 versus 90, so it's barely, but it has crossed below its market sentiment, and short-term sentiment's more bearish than what you're even seeing on the S&P. So, last time we got a bull tag, we rallied, so we'll see if that ends up being, I think it's unlikely because that time the intermediate line wasn't below market sentiment, and this time it is. So a little different scenario there. Of course, your Russell 2000, we've got dark pink shading and a red line. So remember, the Russell 2000 is not only in correction mode, it's actually in bear market mode because it's got light pink shading and a red line on the monthly chart, the weekly chart, and the you can see the monthly chart here. The monthly chart, the weekly chart, and the daily chart. Its intermediate line's in bearish territory. The short-term sentiment looked pretty positive after July, but then back to bearish territory within 2 months, and the momentum line back into really oversold levels, not what you wanted to see after that 2-month streak. And you can see what's happening here. The near term, remember the intermediate line is between 20 and 80, so the near term line crossing above and below it is a signal, and the near term line has crossed below the intermediate line as it's sitting between 20 and 80. that is a bearish long-term signal. And you know, call this pattern whatever you want. It's not a picture perfect pattern, but it's the same idea as a evening star candlestick pattern, a reversal pattern there. You know, after kind of a fake out that we had on June, where we got above these highs after sitting at them, we finally broke through that, and now, you know, we're kind of setting up for a fake out pattern to occur where we get back below that 4,200 as if the breakout never occurred, and ends up being worse than had we just held 4,200 in the first place. So that's something to keep an eye on as we approach, you know, like I said, a new month here. You can see the candle. It ended up being a pretty strong weekly candle here, bigger than what we saw in either of these two declines, is barely, but bigger than what we saw there. We are still above the 200-week moving average. Both of those actually got below it. Remember, we had some intervention here that helped us avoid that correction turning into something more. Not getting that here, right? As you're still got some weakness there. We actually did close. See here, we did not close below that week's low point, and this one we did not close below that week's low point either. This one we did. We did close below last week's low, so that's, and as well as all these other lows. So that's even a more bearish weekly candle than what we saw over here that ultimately turned into transition candles, both of them. So which suggests that, you know, we might not get a transition candle next week, but there's a pretty good chance that we might that we'll get a more bearish candle next week as well, that we won't necessarily turn right into transition. It's unlikely we'll turn right into transition. Of course, your Russell 2000 is even more bearish than that. It did not close below that week, but this one did, right? So this is the week that was kind of the breakdown, like we're getting this week on the SPX. So that's the kind of candle you probably could expect on the S&P next week, as the Russell 2000 appears to be a week ahead of what we're seeing on the large cap indexes. If you take a look at the 3 green arrows, of course, they all are 3 red arrows, right? All 3 red arrows. You are getting close on the Russell to getting a green on the MACD. So, but that again, you know, the no shading is convergence period. That you'd have to get 3 greens, so you have to get back above the moving average and it has to be for more than a day, as you learned here with the Russell and the Dow, for us to get a new trend going to the upside. Looking at the 2-line versions of this chart. Again, you can see we're still below the 8-day moving average. The 8 still below the 17. They're both below the 30. Everything is falling except for the 200, and we're still working our way towards that. The Russell 2000, of course, has gotten below that. It's also dropped below this past 2 weeks, below the 200-week moving average. The SPX made a significant breakdown last week below the 17-week moving average and the point of control. And it's, you know, we didn't break the 30 this week, but we're still below the 17, so we're still in divergence mode with the MACD and stochastics falling. You would expect that they'll continue at their pace. You would expect that they'll continue to fall into bearish levels like the Russell did, would be my expectation there. Let's look at some of these other oscillators. The DMI is still bearish. We're still above 30 on the negative. We're still below 20 on the positive. So we're still at bearish levels there. The RSI and the CCI are also at still bearish levels, below 40 on the RSI, below 0 on the CCI, and well on the weekly, well below 100, right? So last week we got to minus 110. We followed that up with a move down to 183 this week. So clearly, I mean, again, getting below 150 is a clear breakdown into correction. You know, this isn't just a pullback like we had here or we had here at the end of the year. These were typical pullbacks, and you can see what the CCI does in the weekly chart. We had 2 pullbacks here, one in late 2021, one in late 2020. You can see what the CCI did there. You can see a couple normal pullbacks over here, and you can see what the CCI did there as well. That's not what we're getting here. So this is a worse CCI that we've seen since the beginning of 2022. So it would suggest that we're going to get more selling than just what we've seen to the downside there. Ichimoku cloud we're at intermediate trend strength. We haven't developed the mature trend quite yet. Same thing. We're actually kind of at the same levels on IWM, though IWM is well below the cloud. We are at the pink, and we're well below it. SPY is now at the pink, and we're below it. Remember, that is really bearish. Again, that only happens during corrections, because usually by the time we get to the pink, you're already well above it there. You're well above it over here. So those, I mean, that's what pullbacks, you're back above. I mean, that's why it's plotted out 26 days ahead of time. When you get to it, you should be above it, and you're okay. But if you're below it by the time you get to it, that means that you've got more to come, right? I mean, again, you see that, as this, and there's the there's the 2021 and the last couple corrections we had, and or pullbacks, excuse me, and we were well above the cloud by the time we got to the pink shading. But over here, we were still below the cloud by the time we got to the pink shading, which again meant that we had more of a correction. Again, that we're most likely going to make it towards the 200-week moving average. You can see that we still actually on the weekly chart have a bullish trend, but we might be one more week away from it hitting zero, right, like it did over here. And one more week away, and then now we're just done with that trend. We never did get to mature strength, but when you're done with that trend, you're in correction mode. Pullbacks don't end the trend, as we see. We never had a trend going before these two, but this pullback didn't end that trend. This pullback didn't end the trend. These pullbacks over here didn't end the trend. So corrections end the trend on the weekly chart here. Looking at the Bollinger Bands, we are still in the lowest quartile, barely, but we're still in the lowest quartile. The bandwidth is close to breaking out above its 150-day range. And with the close near the lows of the day, we still close below the Keltner channel. So we're getting negative momentum. The bands are outside the Keltner channel, and you're still below the Keltner channel. So again, the longer you stay below that, the more likely we are to trend, as you can see, the positive side in that direction. Let's take a look at today's intraday range, and this is where we had some good hopes. We had a great, if you look at today's gap today, it was almost 0.75% above 1 standard deviation. All we had to do today was just run away from the open. Just take off here, start to fill in that gap, close up in this area. Even if it just got to like 436, that would have been great. But it didn't. We filled in that great gap and then some, and then finished well below yesterday's high point. So even though we had higher highs and higher lows, it wasn't that bullish. And we ended up finishing below last week's low point. So that's bearish, right? When you're finishing below the prior week's low. Also finishing below the value area, so we tried to get into the value area, we couldn't. We're back out of the value area on the downside, so not very good. We don't have a new 4-week low point, but you can see again how easy it is to get one. So once we get a new 4-week low point, this jumps back to 100 and it resets that clock 6 days before it gets below 70, before we can get a breakout to the upside. So it would have been really good. We had a really good opportunity from a runaway gap here for you to come up like this and gotten into this area and gotten into that breakaway gap there and nullified it, but it didn't happen, and it's just what it is, right? We ended up with pretty decent range. It was above average, 6 points. The volume was also 115 million down there, above the average, almost 1.5 times the average, which would be our first 1.5 times. You can see it. The volume really kicks into gear near the lows of those intermediate declines. So we almost got that one there. We still don't have it. But if you notice here, that ATR is ramping up. It's higher. It's about as high, slightly higher now than what it was at the worst there. Again, getting up to 1.5 is typical for pullbacks, much less corrections. Getting above 1.5, closer to 2, is more typical of corrections. Like you see that again. Back over here, when this correction started, we got through 1.5. We got to 1.5 on the pullback. We got through it when the correction started, and that's what we need to keep an eye on as potentially things get a lot more volatile. Because again, we have not seen volatility yet, right? The VVIX is still below 100. The VIX itself is still below 20. It's still below 100% easily. It's barely above 95%. It finished, let's see, where did it finish? It finished below its 200-day moving average, just barely, but it finished below that 200-day moving average. So, again, we generally get above that, especially during corrections. We get well above it. In fact, it starts to turn higher during corrections. So we have not seen volatility yet. Even for just a pullback, we haven't seen volatility yet. So that's those bigger ranges, bigger moves, more volume, that's all coming. Right, we haven't had that, and the move in volatility is so. I mean, again, even for just declines, just pullbacks, we haven't had that, much less more of a decline. So that's why I don't think it would have been nice had we got the runaway gap. But most of you know, watching these videos in my class, market scholars know that I don't expect that we're going to jump up to new highs. I expect that this will turn into correction, still do. And all these indicators I've shown you is kind of supporting my expectations there. Let's take a look at how things finished off the week. So here, let's zoom out here to the full week, which wasn't as bad of a down week as last week was, right? But if you look at the week that was, you can see the dollar ended up the best performing asset class. Gold just got hammered this week, absolutely hammered, especially today. It really gapped up today and then just fell off a cliff. If you look at just today alone, you'll see, what I'm talking about, down 1%, commodities down pretty big, but that's a big move there. Silver just got hammered too. But you can see why. I mean, the big reason why is at least for the week, for the full week here, it was that strength in the dollar. And if I were to zoom out to the last 2 weeks, because that's when kind of we broke out, was last that Monday before. I mean, look at the dollar up 1%. You can see gold's down, bonds are down, which means bond yields are up. Commodities were up, but they're down there. High yield's been holding up strong. Thank you to the energy sector and real estate. Oof, man, real estate just hurting badly. It's all equities. Doesn't matter if it's international, U.S., large cap, small cap. They're all down about the same. So it's pretty broad. This weakness has been pretty broad. It hasn't been necessarily contained to one specific area in the markets. Of course, that dollar has been really strong after that big fake out breakdown here. It's been just about every single week. How many weeks now? We got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks in a row. I was talking about too, the Hakinyashi. Every Hakinyashi closes higher, and that's so rare. Even back here where we had a big long streak of Hakinyashi closes to the upside, you can see not every Hakinyashi close was higher. That has been the case this go around, and you can see if I go to this chart here to take a look at on the dollar, we are easily above the 200 week. There's a trend. There's a golden cross. We're above that 38% Fibonacci retracement of the prior rally after retracing down, breaking down below the 50% with a fake out and then reversing. It is moving back up. We're not quite a percent on there, but we are getting some pretty decent sized candles, and we're getting a move. Of course, a lot of that has to do with the 10-year yield. You can see this is, again, one of the bigger candles on a weekly candle that we've had on TLT. Going back to April and October, the only other times it's been this week, as well as that one right there. And it appears like, again, we're closing, the Hakinyashi close is now below all the lows over there. So now if I were to zoom all the way out, it's not quite below like these lows, which is 2011, right before it rallied going into the credit crisis. There, it really took off going into it and then some afterwards. And you can see, look at that divergence there on the 1040 week, a big time divergence with the lower lows already and easily higher lows, as this is the lowest that we've been. In fact, we're still in the 25th percentile. So, I mean, we're still pretty darn low. If it wasn't for that low, this would be one of the lowest levels for this PPO compared to what was this low point there, and then that low point there, and that. Again, that preceded a good bullish move higher. This one actually preceded a pretty decent bullish move higher into the end of 2021 before things just fell off a cliff. So at some point in time, it's going to rally up to the upside, and that correlation that you have with TLT and the stock market, which has traditionally been bearish, not bullish, but actually bearish. If I go weekly here, and then I change this to like a 13-week correlation, so a quarterly correlation, you can see it's traditionally been bearish, but since this inflationary period started, it's been bullish. Well, I mean, the bond market's telling you we're back to an inflationary period. The bond market and the stock market together are telling you, here we go again, like we saw in 2022 and 2021. But there's going to come a time where this inflationary period transitions to more of a deflationary period where the market's worried about risk, aggregate demand just being broken because of the rising yields. But as of right now, again, TLT falling. There's going to come. TLT has got a very, very low margin of safety. It's well below these averages here on a long-term basis, well below the 200-day average, much less the 200-week. This is, if I were to go back, again, all time on the 200-day moving average, how far below that we are. So here's 200, simple. We are 12% below, so not as low as we were over here, but it is about as low as we were in this level in March of 2021, and then bonds started to rally over there. So again, this was kind of an anomaly here when you had inflation hitting 9%. We're not at those levels, nor I think we'll ever get back to those levels, but it is pretty similar to the type of inflation we saw at the beginning of 2021 when it did start to pick up right about at these levels that we're at right now. So like I said, there will come a time, and this is, a very, again, we're in the 20th percentile here. So there's not very many periods lower than this. You look at all these other periods, remember we're at about, where are we at, 12% right now? None of these periods are at 12%. These are kind of 10 and 11%. When we got below the 200-day moving average, that was about the extent of the weakness. This one over here was about where we're at right now, and we made a run up towards the 200-day in 2009. So, needless to say, this is where we stand. Might not be as low as what we saw last year, but traditionally it is pretty darn low, and usually sets a low so in other words, is it going to go up on Monday and Tuesday? Who knows, right? But it is there is a good margin of safety here compared to say equities, which instead of being that far below its 200-day moving average is actually still easily above it and hasn't crossed below it yet. And whereas IWM is 3% below its 200-week moving average, and even the average of the MACD is down below that. So it's a significant drop, and again, you would expect that that's where things are going to get to. The breadth is still pretty bad. We were positive at the highs of the day today. We were positive. We ended up not only not being positive, but that's a pretty decent level. It's not below minus 35, but it's still a pretty decently negative level. Like barring a tremendous rally next week, we're probably going to drop below minus 500 on the summation index next week, and that's again correction level, not just pullback level, but correction level. When you look at the let's see here. When you look at the other breadth indicators that we look at, let's pull up the new highs and new lows first. It's actually going to be on this one, sorry. Look at the new highs and new lows here first. Here's the number of stocks above the 50-day moving average. Almost dropped below 75 again. This is pretty low levels. Well below 150. The average has now dropped below 150. That's bad. We are the new highs and new lows, at least that they have moved up. That is a decent sign. We are up to minus 188. I'm a venture to guess that the NASDAQ hasn't been. This is the NASDAQ and the New York Stock Exchange. So usually you get the New York Stock Exchange first, and then it ends up being a pretty high number. Or a low number if you're in the positive levels. And then the NASDAQ composite comes in later. So my guess is later tonight, we'll see if that minus 188 sticks or if we end up below the minus 312, which, again, getting below minus 300 for the average, again, barring intervention like we've seen here, that typically tells you. And by the time we did get to minus 300, we were already bouncing there. We're not bouncing now, and we're pretty clearly breaking it. So the breadth is bad, right? Needless to say, the breadth is bad. The money flow is also bad. As you can see here, the money flow is bad, easily in bearish territory below 40. And if you look at the weekly, we are just crossing below 50. So we may just be getting started here. So again, kind of goes to show just how bearish we are. Even if the number itself, if this decline itself is not that big of a number. So it's even less than what we saw in the last two intermediate pullbacks. So even though that number is not as big, again, it is pretty big considering the time. I've shown you that in the last market outlook video. When you look at the rate of change, that is a big number. Let's look at that here, the rate of change. So even though the actual absolute number is not that big, let's see here. What's the rate of change now? It would be, here's the highest close. So if I look up there at the bars, 44 minus the original, the high close bar, so 43. So we have a 43-day rate of change now since the last high close. We're down, 6.5% from that level. Again, to zoom out, that's a low number. Right, that's a low number that typically leads to correction levels, not just these little pullbacks that we saw. So the absolute numbers were bigger here, but when you incorporate timing, this one's actually been worse, as well as the breadth. So it seems like it hasn't been that bad, but it kind of goes to show, and as I showed in my tweet, if we are indeed going to be in a decline, right? If we are indeed going to be in, let me switch this to a weekly chart and get it a little bit time frame, and then we'll switch this out to like a 10% move here. So if this is indeed going to be a correction like 18, COVID, 15, 16, 2011, this early one that started the bear market in 2008, then you can see what the numbers look like in there. And we're only at 6.5%, which means we have some more decline left to go. To get to whatever the number will ultimately end up being for this one. All right, for our trade idea of the day, I wanted to take a look at Walmart. Walmart it's been holding up pretty well, but finally got a bull tag on its daily chart today. So its intermediate line is crossed below market sentiment. It's moving down towards the bottom of bullish territory. The near-term line is itself potentially forming a bearish peak. The momentum line suggests that it is. And we're pretty decently, we're 1% below the 30-day moving average. The last couple bull tags we did rally up, and some of these were kind of some big gains. This basically kind of like a bigger version here than what we saw right now. But you can see there's a lot of signs that Walmart, from a broad market perspective, of course, we're kind of leaning in that direction, but you can see this go around. We actually have a red arrow. We didn't have that over here. We have a red arrow now. You had a lower close, in the Hakinashi. We got the bearish reversal here. Looking at some of the other indicators, obviously we have 3 red arrows on the stock itself. You can see the above average volume as well. Looking at not only did we cross below the 30-day moving average, but we also crossed below every moving average, right? We gapped up. We kind of closed above the 17 just barely, but we gapped up above all of them at the open, above the high point yesterday at the open, and then just fell through everything. Closing below that low point of that little hammer. MACD has now gone negative. It's below its moving average, but it's below 0 now. It's below stochastics is in bearish territory. Looking at the DMI, you can see the breakout on the DMI above 25, below 20. So we didn't have that back over in some of these others either. On this decline, we didn't break above 25 over there. We didn't quite have the break below 20 on the positive over here on that bull tag. So different environment, right? That's why we can't just look at one signal and think, oh, well, that one signal is just like all the other signals. You have to kind of have a process here. We're in the lower half of the chart. We're below minus 100 on the daily, easily below minus 150 on the daily chart. The Ichimoku cloud, you can see we did break below the blue line, still above the cloud, still have a positive rate of change, but the bullish trend we had is gone. So what I've decided, finally let's look at the Bollinger Bands here. And you can see with the Bollinger Bands, we didn't break below the lowest band or the Keltner channel, but we did get into the lowest quartile of the bandwidth, and the bandwidth is really low, so it's, you can see we're pretty close. If we follow through, we can break below that band. So what I decided to do, because again, we're not getting strong bullish signals here, but if you look at if I set up a trade for a bear call spread, but then add on a little bit of extra credit for the same amount of risk on the put side, but it also cuts off, that downside there. But it does give me a little bit more credit for a full position size. You can see kind of where my break evens are. So my break even on the upside is basically reversing today's move and then some, which if it does, we don't want to be in a sideways neutral trade anymore. But look at where my downside break even is. I can fill in a lot of that gap and be just fine on the downside. So it's actually really nice setup here for an iron condor and a kind of a non-directional trade. And if it does go in the direction, that's okay, because we've got a little bit of a negative delta right now on this. So we can we'll take some of that directional trade, and it will kind of add and potentially get to maybe 50% of maximum gain pretty quickly. It is October, so we're at the 20-day mark. So we'd have to do it like Monday if I want to close this trade out early. Otherwise, we'll just stay in this. And again, if it breaks out to the upside, we're bullish. If it breaks down over there, we're really breaking down. So we're going to want to be even more bearish in that case. So there's our trade idea for today. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on our video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Friday night and your weekend, everybody, and we'll see you all on Monday.